You are not going to believe what Goldman Sachs just said. The same Goldman Sachs that said for Q1 of 2023, we would see GDP of 1% when we ended up seeing GDP of over 5.3%. The same Goldman Sachs that also predicted that the Fed would cut interest rates in 2023 when in fact they didn't. The same Goldman Sachs that said that there was a reasonable chance of a recession in 2023, that never happened. Well, now the same Goldman Sachs is saying you can say bye-bye to the historic stock market run, and they predict that the S&P 500 index fund will grow at around 3% per year for the next decade. And the article goes on to say that this is because of their extreme concentration in just a few stocks. This would be what is known as the Magnificent Seven: Apple, Nvidia, Microsoft, Google, Amazon, Meta, that's Facebook, and Tesla. Now, I think this is a little bit of an overreaction. I think this is a little bit conservative. There's a lot of good things happening right now in our economy. Innovation, employment, higher wages. Even in the face of all of this inflation that we're seeing, consumer spending continues to increase. And then there's this. Watch this video from a friend of mine.
Entering a new economic supercycle. That means a sustained economic expansion that lasts longer than a typical business cycle. Economists have made this claim, and they said the last 15 years are bold.
So on the one hand, we have Goldman Sachs being extremely conservative, and on the other hand, we have Gio Hussar and economists. I keep saying economists when it's economists. We have economists saying that we could see a potential supercycle, which means prolonged and sustained growth that could last up to a decade or longer. You could say that I'm optimistic or that I'm bullish on America, but I don't think we're done with our massive growth just yet. I think Goldman Sachs is wrong. I mean, they've been wrong before. But don't worry, I'm going to show you how to invest or how to prepare to invest for both scenarios. Let's go with Goldman Sachs first. The S&P 500 has an average historical rate of return of around 10%, although it's been a little bit higher over the last decade. They're saying, it's gone. It's going to be 3% now for the next decade. They're saying tech has already had its big run. What do you focus on then? What does well in periods of economic downturns or slumps? And the answer is dividends or dividend ETFs. And if you don't want to go through all the time and research that it can take to find individual dividend-paying companies, you've got options here. One would be a dividend ETF like SCHD, which you can see in the last year is up 23%. And when you're looking for dividend companies, you want to find things called dividend kings and dividend aristocrats. These are companies that have raised their dividend for 25 or 50 years or more. So NOBL is one option, and Regal, REGL, is another. You might also consider government bonds or treasuries. You might also consider what we either call consumer staples or consumer defensive products, stuff that we're going to use no matter what. Here is XLP. It is a consumer staples ETF. Or real estate investment trusts like Realty Income. You might also consider stuff like utilities ETFs. If you think we're going to see slow economic growth, some other things to consider would be sitting on cash or gold. But what if you think Goldman Sachs is wrong and Gio Hussar and other economists are right about a forthcoming supercycle? Then how do you invest? I mean, they're already saying that these tech stocks are overvalued. So what do we got? Well, if you watch Gio Hussar's video, some of the things he talks about are improved infrastructure and cybersecurity. So if you think we're going to see a boom in affordable housing, you might want to check out an ETF like this, the ITB Home Construction ETF, which you can see in the last 12 months is already up 66%. If you think we're going to see an increased need in cybersecurity, I mean, take me, for example. I got a DM this morning from a woman saying, hey, my friend sent you a lot of money that you said you were going to invest and we haven't heard from you. Well, that was a deep fake or a scam account. So that could be a need for some more cybersecurity, or more people working from home would mean that more companies would need cybersecurity, or cyber terrorism could be on the increase. Then you might want to consider a cybersecurity ETF like Hack, which you can see is up 38% in the last 12 months. And if you're sitting there going, well, what are some of the companies in this ETF? All you got to do is click right here where it says holdings, and it'll show you their top 10 holdings. And you can see that their largest one right there is Broadcom, but they also have Palo Alto and CrowdStrike. Another thing that Gio Hussar talks about in his video is the connection between national security and infrastructure. And so you might then also consider an infrastructure ETF, which is up 36% in the last 12 months. Now, remember how Goldman Sachs at the beginning of the video said, well, we've seen an overconcentration in the Magnificent Seven. Just a handful of huge tech companies have done really well, and they might not continue to do so well in the next decade. Well, the thing about a super cycle is that it doesn't benefit a lot of those companies. It benefits a lot of small cap companies, and here's why. Small cap companies can have higher growth potential. And they can adapt and move and pivot a little bit more quickly to meet consumer demands, whereas these larger companies, it might take much more time for them to implement changes in strategy. In a super cycle, there's also increased investment. People are starting businesses. People are looking to smaller businesses to fit demands or address new issues that maybe haven't really been addressed yet. Small cap companies also benefit from something called M&A activity, or merger and acquisitions. So big companies might say, oh man, we really wish we had this technology, but it would take years to implement. Oh wait, let's just buy this small cap company. So a lot of investors invest in small cap companies, not just for the potential growth that they might see, but also for the potential for mergers and acquisitions. But how do you find small cap companies to invest in? Well, you just go to a website like Seeking Alpha and you type in small cap ETFs. And here's one right here, SPSM, which you can see is up 29% in the last 12 months. And you might say, I don't recognize any of these companies. Well, yeah, because they're small cap. They're under the radar. Here's another small cap ETF for you to consider. By the way, you need to pay attention to something called the expense ratio or the fees. Some of them can have slightly higher fees, which you might not want. And another thing to consider is the potential for the expansion of green energy. When we talk about our infrastructure and our need for more electric vehicles or the consumer demand for more electric vehicles, a lot of people say, hey, our infrastructure, it can't handle this. Well, uranium, which can be used for lots of things, but one of them is to produce electricity, is known as being clean because it doesn't put out a lot of greenhouse gases, but it's a little bit more complicated than that. Both Amazon and Google use a tremendous amount of energy due to their cloud and data centers, and most of these plants generate their electricity in part by using uranium. Whether you think we're going to see more cybersecurity, an increase in our infrastructure to accommodate more electric vehicles, big tech companies using more and more data centers, all of them might factor in uranium a little bit. So you might consider also a uranium ETF, which you can see is up 27% in the last 12 months. But you know what I think is most interesting about Goldman Sachs is that whenever they say something positive about the economy or a company they really like, people go, well, they're just lying. They're lying about it. But when they say something negative about the economy, everyone's like, oh, did you hear what Goldman Sachs just said? Oh no. The whole takeaway here from this video is to be prepared and understand the benefit of a diverse portfolio. You got to do your research and you got to smash that follow. All right, thanks for watching. See you later.